Hello, welcome to our program. We're going to give it just 1 minute to let people join and then we'll get started. All right, I think we can get started here. Thank you for joining. This is a joint program between BMO Capital Markets and Gardner Law, and we've pulled together a group to speak today with a wide range of experience in investment banking, healthcare M&A, compliance, and privacy, of course, all of which intersect when you're assessing deal risk in this space. Just a few housekeeping items before we get started. This program will be recorded. We will have time for questions at the end. So if you do have questions, please submit them through the questions tab and GoToWebinar. And the slides are available under the handouts tab within GoToWebinar. All right, and with that, I'll jump quickly into presenter introductions. Today, you'll be hearing from some professionals from BMO and Gardner Law, Marc Ogborn, who leads the Healthcare ECM group at BMO, Trushar Patel, Director of Healthcare M&A at BMO, Kevin Kim, who's leading BMO's MedTech coverage. And then later on in the program, you'll hear from myself, Amanda Johnston. I'm a partner at Gardner Law, and I'll be speaking on compliance and regulatory risk in M&A. And finally, my colleague, Paul Rothermel, a senior attorney at Gardner Law, who specializes in privacy, cybersecurity, and health law. All right, so with that, I think I will pass it over to BMO. I believe Kevin is going to get started with a market update.
Great, thanks, Amanda. And just to make sure, can you hear me okay?
Yes, we can.
Okay, perfect. So thanks again for inviting us to join this webinar. We're excited to be partnering with you and the Gardner Law team on this important topic. Before I turn it over to Marc and Trushar, I thought it'd be helpful to set the stage with a brief overview of the state of the medtech market as a backdrop for what we'll be discussing later in the presentation. So if you go to page 4, first off, I'm sure everyone's acutely aware of the dynamic tariff situation in light of the president's announcements yesterday. Definitely an important factor impacting the market broadly, but would like to put that aside and focus the discussion around the medtech market specifically. So a brief history going back to COVID. There's definitely been some ups and downs, and I'll talk about the market roughly in 3 categories. During COVID, post COVID, and kind of where we are now. But you'll recall back during COVID, it was very macro driven market with many challenges kind of faced by the medtech market, um, including staffing shortages, procedure volume declines, particularly for elective surgeries, and supply chain issues, which all led to a highly volatile market for medtech. Coming out of the pandemic, medtech fundamentals have significantly improved with largely a 180 reversal of all of these fundamental trends. However, the market didn't reflect that as there were other macro factors at play. Again, you'll recall inflation, interest rates kind of being a big topic back then, as well as the advent of GLP-1s that temporarily put pressure on medtech stocks. But you'll see on page 4, the medtech market remained resilient. 2024, by many measures, was a very successful year, not only in stock price performance, but in terms of IPO new issuance, as well as deal volumes in the M&A market. So coming to 2025, it appears to be a rocky start. There are some new investor concerns now. I mentioned tariffs, obviously, is a big one. Um, Potential just pressures on hospital capex for medical devices, as well as kind of the back end loaded um, weighting in terms of the guidance that's been provided by the larger public medtech companies out there. But interestingly, um, if you look at the chart, particularly on in the gray box there, year to date, large cap medtech has outperformed, and it's up almost 8%, while the broader market was down over 3. So I go through all of that to emphasize just that you know the market backdrop is important to transactions. We'll be going through materials on preparedness for IPO and M&A transactions. But in the background, there's always market considerations to be aware of. And regardless of whether it's a constructive market or a challenge market, um, our point really is it's important to be prepared. It's important to understand um, how these processes work, and that's what we'll be going through today. So, with that, why don't I turn it over to Marc?
Great. Thanks, Kevin. As we said at the outset, Marc Ogborn, I run healthcare equity capital markets at BMO Capital. What I would tell you is, my um, the breadth of my kind of responsibilities is all of healthcare. It includes medtech as well as biotech and healthcare services. But what's interesting, what we're going to talk about over the next couple of pages here, and as we get into the deeper into the presentation, is obviously focused on medtech, but the medtech IPO market has shown remarkable resilience. Relative to, well, certainly relative to biotech, and it's been more active so far than the services market. But on this page, what we lay out here, if you look at the upper left graph, now this is across all sectors, IPO activity across all sectors. As you can see, we are starting to see some momentum to start 2025. Clearly, as Kevin was indicating, the immediate market backdrop may dampen some of the activity, but we do expect that to subside, the volatility and the market to rebound. I will tell you, coming into 2025, there was a ton of optimism for a big rebound in IPO activity. That has been, as I just said, tempered somewhat given the macro backdrop. But if and when we see that volatility subside, there is a deep pipeline again across all sectors, including medtech, that are looking to get out into the public markets. On the upper right graph here, this is kind of an important point, right? This is how the IPO since the start of last year have priced in the current market across all sectors. The median IPO discount is 23%. So that means, a 23% discount to what is viewed as where the IPO, where the company should trade on a fully diluted basis, where the comps are trading in the public market. The medtech IPOs, which we've circled in red, these are the IPOs that have been priced since the beginning of last year. Frankly, they've all the medtech IPOs have been, Q4 of last year and then early this year. Clearly a little bit more variance in discount. Some of them certainly tighter than that 23% that's been across the board. Kestra, as you can see there, priced at a premium to where the comps were the comps that were being looked at. The bottom, I was kind of as we kind of just kind of go through the medtech the IPOs more specifically. You look at the bottom left graph here. This again shows, similar to the across all sectors, how we do see some rebound in that market. Again, notably, the two that were done in 24 and the two that were done this year have all, the two last year were in the fourth quarter of 2024. Again, look at 2022 and 2023, no activity at all coming out of COVID when the market was depressed. The medtech market, there was no activity as the medtech stocks traded off coming out of that COVID environment. But we are seeing a nice rebound um, um, to start 2025. I think in some ways the most important graph to look at on this page is the bottom right. And this is just shows you how well the medtech IPOs are trading in the aftermarket. In many ways, the number one factor to number one factor in achieving a more robust IPO market is how did the previous IPOs trade, and you can see medtech outperforming the other sectors in the market, which is very encouraging. What I would tell you, one factor there certainly is the fact that if you are a growth or a generalist PM looking for healthcare exposure in this market, is very hard right now for those investors to step in to the biotech IPO market. So where we are seeing those types of folks step in is to the medtech IPO market. Granted, it's an N of 2 for this year, N of 2 of last year, but medtech IPOs are bringing financials to the market. They're generating revenue, where biotech is not. It's more of a belief in the science. So we are seeing less generalist activity in the biotech side and more on the medtech side. If we want to flip to the next page, here we drill down, just kind of give you all a snapshot of what has been done specifically in the medtech IPO market. A few observations that I would point out on this page. First, valuation, which is kind of 2/3 the way down on the page. You can kind of see the row that includes valuation. Certainly, well, maybe a comment first on where this comes from. This is derived from Renaissance Capital, is a source that we use in terms of evaluating how these are pricing relative to the projections that the Renaissance is putting out for each of these companies. Valuations, there obviously there's variance in these numbers. Taken together, removing Anteris was already trading in Australia when it came public here in the U.S. So kind of taking that one out, you look at the other three. On average, we're talking 5 to 6 times forward revenue is where they traded. Clearly, some variance there, right? With Kestra at 8 times and Beta at 4. Interestingly enough, when the medtech IPO market was kind of rocking and rolling, so to speak, in 2020 and 2021, we were seeing similar multiples. It was 5 to 6 times is where most of those stories kind of came out. A couple of other kind of important notes that I would just comment on for the group here. 3 of the 4 IPOs, and all 3 that are quote unquote pure IPOs, again, Anteris being one that was already trading. The other 3 all upsized their transactions and all priced above the initial IPO marketing range. And what does that tell me? That tells me that, again, going back to the point I was making on the prior slide, we are seeing very strong demand for these stories in the public market. Again, seeing more demand from not just the healthcare dedicated community as it relates to investors, but seeing generalist demand for these stories as generalist investors who are looking to participate in IPOs and looking for exposure to healthcare have in recent months shied away from biotech, just given the volatility in that sector, and have more readily stepped into medtech, given the financial profile of these companies relative to their cousins in the biotech market. So with that, I will perhaps we can go to the next page, and I believe Trushar is going to take over talking about the M&A market.
Yeah, thanks, Mark. I think Kevin's going to handle these next few slides, and then I'll jump in.
Great. So, yeah, starting on page 8, just briefly on the M&A market, I just wanted to highlight the clear boom in terms of M&A volumes and aggregate value in 2021. Volumes have come down significantly on a relative basis, but I think it's important to zoom out in order to see that the levels post-COVID 22, 23, 24 are somewhat in line with historical levels, albeit slightly below kind of where they were in the late 2019, 19 and 2020. 2024 has continued to make improvements on an aggregate deal value, which is up 12% over 2023. So the M&A market is definitely moving in the right direction with more deals in terms of just deal volume and value, aggregate value going up. On the next page, the question is really, will this continue? And there's a lot of uncertainty in the market right now, as all of you are aware, but from a dry powder perspective, on the bottom, middle and right, part of the page, you'll see large cap med tech. They have a lot of cash. They built a lot of cash kind of going into COVID, and those cash levels have remained relatively elevated and available to be deployed for M&A transactions. The other point I wanted to make is private equity. They're emerging as a relatively new buyer for medtech assets where they historically have not been. Healthcare private equity funds have historically essentially been healthcare services funds, and as there are some challenges in that market, they are definitely looking for other areas to invest within healthcare. And given the profile of medtech generally, the defensive nature of that subsector, there's a lot of focus going into that right now. Some feedback we've heard so far in 2025 is that it's a slow start in terms of deals that are in the market. That's coming after a lot of optimism coming into 2025, similar to the IPO market. But there's been some disappointment, I would say, in terms of the number of assets that are currently in the market. I think the view is 2025 is still expected to be a good year for M&A, but it will be back end loaded. On the next page, just another barometer for market health is capital raising. And the only point I just want to make here is, the increase in private rounds in 2024, again, contributing to the general market health for medtech, broadly speaking. And then, Mark had touched on the IPO market also moving in the right direction. So with that, a little background on the M&A market, but I'll turn it back over to Mark and Trushar.
If you want to flip one more page here. Yeah, so components for initial IPO, for initial public offering IPO. This just lays out broad strokes the process of going public. What I would tell you here in terms of the highlights on this page that are most kind of relevant for you all, you see the first bullet there on the upper left, selecting an IPO team and hosting an organizational meeting. Once that has happened, it is in our experience kind of anywhere from 4 to 5 months from that process forward to becoming a publicly listed entity. Some of the key kind of steps along that journey is drafting the S1 and the roadshow deck. The roadshow deck is obviously critical not only for the IPO roadshow itself, but there's the testing the waters meetings that happen before the actual IPO roadshow. In many ways, from my standpoint, from an equity capital markets point of view, testing the waters is probably the most important part of the preparation process for an IPO. Why do I say that? Because this is where companies and the banks that are advising the companies will receive feedback from investors on how the story is being received, how they are thinking through comps, and obviously it gives you a lens into valuation and what you should expect as it relates to valuation. It also gives you a chance to um, uh, tweak your story if that's necessary. As you're hearing from investors, they want to hear more about this or something else. You can certainly adjust fire before the actual IPO roadshow. This is also where you'll hear from some investors that will be fairly forward leaning on their willingness to participate when you do ultimately launch the IPO roadshow. So maybe with that, I'll pause and turn it back over to Kevin and Trushar. We can certainly answer any questions as it relates to the process at the end.
Great, thanks, Marc. I appreciate it. Trushar Patel, based in Minneapolis. I lead our healthcare middle market M&A practice. Just before we dive in, I wanted to share some quick observations from our engagements with clients in the medtech sector. I think a lot of what we'll cover today may feel intuitive or even obvious at first glance, but what we consistently see in real world transactions is that many companies have some of the right pieces in place, others partially addressed, and a few areas that are either undeveloped or simply not at the level that buyers expect. And that's where value can be gained or lost. So it's not just about having a strong product or promising growth. Those are important, obviously, but buyers today are under pressure to justify premium valuations with clarity, completeness, and confidence across the board when it comes to financials, IP operations, regulatory, and beyond. So what we'll share with you today is about sharpening around the edges, helping you think through best in class preparation, what companies are expecting, and how this could hopefully lead to unlocking more value with the right groundwork. I think we've touched on some of this in terms of strategic versus private equity, but just a few points to highlight. As Kevin mentioned, we're seeing an increasingly dynamic M&A environment for medtech. More private equity firms are emerging as key players. Many of these firms don't just bring capital, but a pretty deep thematic focus and dedicated healthcare teams. And then for founders of private companies or private company owners, private equity can offer flexible transaction structures ranging from minority to majority. And then, importantly, the option to roll over equity and participate in future value creation. And then on the strategic side, they prioritize, generally speaking, complementary technologies, access to new markets, and solutions that meet or that address unmet clinical needs. So key criteria, though, I think that you'll find across both types of investors is innovation with IP protection, demonstrated growth or a clear pathway to what growth looks like, and regulatory and reimbursement pathways. And the key is align your positioning to what matters most in terms of the buyer that you're targeting. Next slide, please. So we'll talk a little bit about preparation. I think any successful M&A process begins well before you enter the market, if that's a path that you're going to take, and preparation is critical. And they'll look at a number of areas, and I'll just quickly touch on a few of these. Obviously, the management team, they want to see leadership that's credible and capable of scaling, and a strong team really adds to enterprise value. I think obviously financial performance, clear track record of growth, or a clear plan to drive growth and a forward-looking strategy that's grounded in reality can significantly improve buyer confidence. I think another area is operational maturity, especially with respect to capital expenditures and cost control. If your business needs heavy investment, that should be addressed with data and context. And then, I know Gardner Law will touch on this, but legal or regulatory concerns, outstanding claims or unclear IP rights, it's critical to address them proactively. Now, in short, buyers are looking for businesses that are clean, scalable, and positioned for growth. Next slide, please.
Trushar, just to jump in here, I
Yeah.
think you covered that well. A lot of these points, not dissimilar to as it relates to an IPO as well. So just wanted to highlight that. But
Yeah, no, exactly. I think preparation is key in both scenarios. On this and the next page, really focused on kind of the building blocks for M&A readiness. Timing becomes an essential factor once a decision's being made on pursuing an exit. And given today's regulatory complexity and market scrutiny, I think these items should be begun well in advance. They should be part of how you're building your business organically. And so, a lot of this should hopefully be a part of what you do day in and day out. But, financial statements ensure GAAP compliance, address any anomalies. Buyers want clarity and consistency. Simultaneously work to resolve outstanding legal or operational issues, IP questions, pending audits, commercial agreements with gaps. Buyers will examine metrics that matter: revenue, growth predictability, gross and EBITDA margins, R&D efficiency. So the more precise the data, the better the story holds together. And then again, capital efficiency. Show how your use of, it's getting a bit of an echo, Tracy. Um, Show how your use of funds has translated into growth. And this is particularly valuable with private equity buyers. And then if we go to slide 16, and then the second half of the plan, I want to move into operational readiness. Well-documented processes and SOPs show operational discipline. From a manufacturing perspective, there's a lot of confidence in your ability to scale while managing costs. Again, team collaboration, experienced leadership, and track record of success. And then on the due diligence side, there's always be prepared across financial, tax, legal, and regulatory. Um, any red flags such as poor documentation, regulatory ambiguities, or unclear IP rights can delay a process or can jeopardize a deal if they're uncovered at the last minute. So completeness and accessibility can make or break deal momentum. If we go to the next slide. Just want to leave you with some key takeaways and potential action plan as you're considering if exit, whether IPO or M&A is something that you're contemplating. Maximizing deal value isn't always about the financials. It's also about articulating strategic fit, synergy opportunities, and how your business integrates with the buyer. Risk mitigation, and Gardner Law will touch on this, but how you put together your documents, reps and warranties, escrow structures, if there's earnout mechanics, how those are thought about and how those are constructed. And the most successful transactions in our experience have one thing in common: well-prepared sellers with strong leadership team and a clear, articulated growth strategy really go a long way in enhancing the conversation with potential buyers. So, and then just lessons learned, highlighted at the very top there, but early preparation. I think another key thing is building relationships well in advance of any exit consideration, whether it's a private equity buyer or a strategic. I think building those relationships months, years in advance is always beneficial. And then transparency and proactive storytelling. I think always drive successful outcomes. So from here, I'll turn it over to Amanda.
All right, thank you. Just gotta reorganize here. All right. So now that we've got kind of an update and some plans and outline for kind of getting ready, I want to talk a little bit about compliance. And Trushar, you mentioned it a little bit, but we are going to be talking about kind of deal ready compliance essentials, give you some tools and guidance to really assess and strengthen compliance programs in the M&A context. And this, whether you're a target or an acquirer, this is relevant in the M&A space. So this framework is probably familiar, the 7 elements of an effective compliance program. It's based on the US sentencing guidelines, and it's reinforced by the DOJ and the OIG. So how are the 7 elements important in the context of M&A? And the short answer is it's because these are the standards that the DOJ and the OIG use to judge whether a compliance program is effective. So if you are acquiring a company, you want to know whether their compliance program would hold up under that same scrutiny, because you may be inheriting their risks. So during due diligence, we're often evaluating whether the target company has these elements in place and whether they're doing more than just putting words on paper. We really want to see how the compliance program is operating in practice. So why is compliance important in M&A? It's not about checking boxes and due diligence. It really can make or break the deal. We've seen examples of that. And it boils down to 3 kind of main reasons. So first, post-close enforcement and litigation. So when an acquiring company buys a target, they also inherit its past. So even if the acquiring company had no involvement in any prior misconduct, they could still face investigations, government enforcement, or even litigation once the deal closes. If DOJ or OIG finds out about improper billing, kickbacks, or FDA non-compliance post-close, it can now be your problem. And that exposure can be expensive, and it can take a lot of time. So secondly, valuation and risk allocation. Compliance gaps can directly impact how a deal is structured and priced. So if a target company doesn't have a very strong compliance program, that could add risk, which buyers may account for in the form of lower valuations, holdbacks, or special indemnities. So when compliance is weak, it affects how value is allocated in the deal. And on the flip side, a mature compliance program can actually enhance the company's value and reduce the need for post-close cleanup. Post-close remediation costs is the last point on this slide. So if compliance gaps are found after closing, you're not just dealing with risk, you're dealing with money and expenses and funds. You may have to bring in consultants, you may have to rewrite policies, retrain, overhaul systems, launch compliance investigations into legacy issues, and these unplanned costs can add up quickly. And they also create operational distractions at a time when you're really, trying to focus on integration and moving forward. So the bottom line here is a target's compliance program or lack of one isn't just a legal concern. It really is a valuation issue. It's a risk allocation issue, and it's a cost issue. And so it should be, really front and center in any M&A discussion. So I actually came up with these 4 specific inquiries because I think they really help demonstrate whether a compliance program is actually functioning in practice and not just existing on paper. So they're also valuable whether you're a buyer or a seller. For acquirers, these questions may help uncover operational maturity and identify risks that may not show up in financial statements or the data room. And for targets, being ready to answer these questions really shows that you're serious about compliance, and that can boost buyer confidence and even deal value. So these Again, I made these up. I would, if you're a target company or if you want to be acquired, it's always good to go through these and kind of practice how your responses, how you would respond. So the first question, provide the compliance committee meeting minutes and related materials for the last 2 years. So just a few, I'll just say a few comments on each one. So here you're looking for, documentation that shows regular meetings, active participation in those meetings across functions, and really substantive discussions that tie back to compliance risk areas. So training, metrics, audits, accountability, investigations. So a red flag here would be having no formal committee or having meetings but no documentation, not following up on action items, or lack of substance in the discussions. So the second question here is, what triggers the need for a compliance audit and what does a company do with the results? So here we are looking for whether there's a plan or a cadence for audits, whether high risk areas are being covered by those audits, and whether findings result in corrective actions and follow-up. So if there are no audits or vague answers, that would be a red flag here. But so is a lack of documentation or follow through if you are doing audits. So if you are doing audits and not following up, that can be just as bad as actually not doing the audit. And the last bullet on this page, the third bullet on this page is a good one. What triggers a compliance investigation? You're trying to understand whether there's a formal process, how issues get escalated, how quickly investigations are launched, and if they're conducted independently or if you have an outside person helping. So red flags here would include not having a clear policy in terms of what triggers an investigation or having one and not following it. And finally, describe how the company's risk assessment process feeds into its compliance program. And I feel like this is probably the best one on here. So here we're looking for, is the company identifying and rating risks appropriately? Are they reassessing their risk profile on a regular basis? Is it a process that's cross-functional? Is it taken seriously? Here, if they look confused or start talking about quality system type risk management or risk assessments, that's a red flag. If they don't know what their risks are, then they probably aren't tailoring their compliance program appropriately. So these questions, I just give them as an example of kind of getting to the meat of the issue. They help cut through the noise during diligence because they're focused more on what the company is doing versus what is in their compliance policies. And that's the real test of program effectiveness, and it's where diligence should focus, especially when there's limited time and resources. Let's shift gears for a minute and just talk about something that's made some waves in the M&A and compliance world over the last couple of years. So the DOJ in October of 2023 announced a safe harbor. So it's an M&A safe harbor policy. Again, it was announced in October 2023. It's part of a DOJ-wide effort to encourage transparency. So the DOJ really wants people to self-disclose or voluntarily raise their hand and if they find misconduct. So how it works is if a company discovers misconduct in a target they've acquired or they're about to acquire, they could be eligible for something the DOJ calls a presumption of declination, which means DOJ won't pursue enforcement as long as certain conditions are met. And so the key requirements again are you have to disclose to the DOJ within 6 months of the closing date. Full remediation of the issue must be completed within 12 months. And if those are met, there is a presumption that DOJ will decline to prosecute the acquiring company. That presumption is not absolute. So the DOJ will still consider whether there are any aggravating factors. These could include things like executive level involvement in the misconduct or a history of repeat violations. So this just wanted to include this in the discussion as it it is absolutely relevant in the M&A space. You want to have discussions before you go into diligence in terms of, you know, would we take advantage of this safe harbor if we do find something, and having that discussion ahead of time so that you're not racing against the clock. All right, so tips and best practices during M&A due diligence for acquirers. We always recommend interviewing staff across the company. That really helps get a sense of the culture. Asking questions, just kind of how processes work, who's in, you know, who has responsibilities for what, getting a good sense of leadership style, and conduct diligence using publicly available tools. So Google, use all of the tools or references and resources at your disposal. For targets, kind of the #1 rule we always say is do not share privileged information without approval from counsel. So if the diligence calls start asking for, or if the discussions and they start probing into some privileged information, do not share without approval from counsel. Limit information disclosed and only to those persons necessary. It's kind of like an audit. So take credit for improvements made, but really, you know, answer the question asked, respond accurately and completely, but don't get tempted to reveal everything. You don't need to. All right, and did I just go back? Sorry. All right, so key takeaways before I pass it over to Paul. A strong compliance program can be a real differentiator in today's deal market. So investing early in compliance, again, weighing the M&A safe harbor pros and cons before you begin due diligence, involving compliance from the beginning in discussions, and again, proactive compliance has the ability to boost valuation and attractiveness for companies. All right, and with that, I will pass it over to Paul.
Hi, everyone. Thanks for joining us again this morning. So we'll be talking briefly here about some cybersecurity trends we're seeing, especially in the medtech front, and how that impacts M&A, both from the acquirer or the target perspective. Many of the slides are going to specifically focus in on what might acquirers be looking at and advice for inquirers, and I think that's unique and helpful for targets to think about what is it that those strategics and potential buyers that you're looking at might be looking for and be considering as they look at your business or assets that your business might have. So let's go ahead and dive in. So first, we're gonna look at the landscape. So there's some general kind of news and activity that I think is helpful to frame what we're going to discuss here, and then look at how does that impact M&A, what kind of things should be considered around that, and then further get into some practical things. What are some ways that targets and acquirers can really evaluate these risks and try to avoid some of the pitfalls that might come up as these deals are being developed. So we'll dive in here. So I have a few breaches noted here that occurred within the medical product space. Not to name and shame in any way, these are victims, and that's generally a good perspective, I think, to have about cybersecurity and how, for the most part, companies are trying to do their best to protect patient data, limit access, do the right things, but there are criminal actors out there, and their goal and their livelihood is dependent on accessing and using and misusing data. So there's certainly things that companies can do better, and we want to talk about that, but highlight that these are victims, and this is a challenging area to deal with. So the first one there, I just like to point out that there are different vectors or ways that cyber attacks can occur, any company at any time is vulnerable to one of these in different ways, whether that's through an email compromise, as we noted here on the Zoll Medical breach, whether it's systems that are actually storing patient information directly, like we see in the LivaNova breach, or the Henry Schein breach, where there was a ransomware attack and that really not only impacted data, but it challenged the business in terms of interruption and reduced the ability to deliver on promises to customers and directly impacted sales in that case. And I also note in each of these where we have some data around the impact, there's a financial cost to these incidents. There's not only the initial cost of, well, now we have to pay a ransom or we have to pay fines or these different avenues that costs can arise, but also the follow-up to that. There could be reputational damage that impacts customer purchasing. You might have to offer discounts to incentivize purchases once you have experienced something like this. There may also just be a reluctance to do business with the company or lack of trust. So there's a lot of impacts that may not even be immediate that can come out of cybersecurity incidents. So I think that's helpful to understand. At the same time, while data and data breaches are a significant risk for companies in any space, but medical device or healthcare oriented companies, obviously, if you're in the med tech industry and you're developing products that directly impact patients, patient safety and how that is protected is also very critical. So I've highlighted a couple of relatively recent examples where cybersecurity of a medical device has been at issue and been something that's addressed. Thankfully, to date, we still don't have evidence of any or reporting that confirms any medical device malfunction caused by a cyber attack that has directly harmed a patient in any significant way, but there's certainly the possibility of that happening. And so we're very keenly aware that such an event would directly impact the value of that product or even the trust level that might be towards that company, or maybe that product might even in some cases have to be taken off the market. So there could be direct ramifications through recall or other potential issues. So I think it's helpful as we're looking at M&A from whether it's the target perspective or the acquirer perspective, is that cybersecurity is always going to be a risk. There is no if about it, there is only a what. What is the risk? How significant is it? Is the company, whether it's the acquirer or the target, aware of those risks and addressing them in an appropriate manner? And then from there, it's really, once you've recognized that it is a risk, how do you actually approach that? What sort of steps can you take to enhance your programs or develop the technology necessary to reduce that risk to an acceptable level? So what targets are doing is looking at acquirers are doing is looking at targets and thinking about what would the impact be if there were a breach, or if there is an underlying breach that we're not aware of at this time. Is that something that we can tolerate, or is the diligence that we're doing revealing gaps that might lead to more significant level of risk? And so that's the kind of mentality that acquirers have, and therefore targets really need to understand that and bring to the table the kinds of, as Amanda mentioned, from a compliance perspective. Similarly, from a cybersecurity standpoint, what kind of program is in place? Is it auditable? Is it demonstrably protecting information, protecting patients, whether it's on the device level with quality systems, or on the data level with kind of a program, software, vendors, all of those elements of a good information security program. Those things need to be in place to show acquirers that there is a robust, we're thinking about this, we're prepared kind of mentality at the company. And I also highlight there's this really great informative cost of a breach report that IBM has been releasing recently annually. And so the cost of a breach approximately in the healthcare space, and it's not as exact to medtech or to this kind of FDA-regulated industry, but it's obviously a very large potential expense. And so any acquirer that looks at a target is going to be evaluating, strategically, does this work out for us if we have this potential risk of a breach hanging over there. And as we've noted, these kinds of issues, whether they're on the surface or underlying in the business, can directly affect valuation. So we've seen that example. It's been years now, but when Verizon was looking to acquire Yahoo Inc., there was a significant breach that occurred in the midst of those negotiations, and that led to a significant discount in terms of valuation of that company. It was around a 7% reduction in price. We see that same kind of thing going on in many different M&A transactions, that things like cybersecurity incidents or other risks that arise can directly impact the value. And part of that is because, as Amanda mentioned, you do inherit those risks and liabilities of the prior entity, but further, there's remediation costs that come with going into an organization or acquiring an organization or merging with an organization that doesn't have adequate security. And there could be latent risks and even very high costs for kind of bringing up to speed the cybersecurity infrastructure that's there. Maybe even some critical piece of software to a product is not in compliance and is even maybe written in a way or coded in a way or built in a way that isn't secure. And so the costs of remediating some of those risks can be very high. So thinking about that as a target in advance and developing your products with the security by design or privacy by design principles can really help you prepare for the kind of diligence that you might see, and then thereby improve your ability and valuation as you're looking at acquisition. And one thing I thought was very interesting as I was looking at these, as I've looked at these over the years, is that there's evidence that's been found that cybersecurity incidents and the threat is higher once a deal is announced. So there's a sense in the cyber criminal world that if we're looking at companies that are in the midst of transitions, ownership transitions, mergers, acquisitions, there's often a period where cybersecurity becomes more lax or there's kind of gaps within that process, especially as integration and other activities are going on. The focus is on getting the business rolling in a certain direction. And so sometimes there are security gaps that arise in that scenario. So there is a sense that we should be extra vigilant as these things are going on. And I also want to note, one of the things that cybersecurity can impact is products. So we do see the potential for a product losing value because of a cybersecurity incident or some gap in the cybersecurity plan. So how do we avoid some of these pitfalls? If you're on the target side, kind of think of this in the inverse. What are the acquirers looking for? So acquirers are trying to get an accurate view of cyber risk, and they're usually trying to do that in a cost-efficient way. They're probably not, in most cases, going to send in a whole team of auditors and pick and look under every rock. That's not usually how this goes. There's more often kind of a strategic risk-based approach. As Amanda mentioned, this similar to an audit, you'll probably have a data room, you'll have some questions, some written questions, and then some calls to follow up on that. Often we see those kinds of tiered based on, okay, first let's start with the high level and understand what's going on, and then dig into some of the details where we see some potential issues. So there's certainly going to be a sense that the acquirer wants a really accurate view of what's going on, but in a cost-effective way. They're aware that there's a lot of potential risk and that there's a lot of regulators and many regulators that look at cybersecurity and privacy issues carefully. And so they're balancing these risks as they look at the target. And if you're on the acquirer side, you really want to understand the target that you're looking at. What kind of industry is this? What are the key products? Are there software elements or other connected devices or programs that are being operated by that target that might have additional or raised or increased security risk or privacy risk. And then once you do kind of evaluate and assess these risks, there's some sense that vulnerabilities could very likely be exploited. So if you do find that the target, let's say, has no information security program, an acquirer is most likely going to assume that there's already been some exploitation of that major vulnerability. So having that in mind will help, I think, targets as well look at themselves with an honest view and say, well, do I have vulnerabilities that I need to address? We can jump to the next slide there. And then last, I think it's worth noting that just because there's not a breach evident doesn't mean that there is no risk. So risk is really more about what are the controls in place and do they mitigate those risks? So there may be a situation where an acquirer even asks, do you have any recent data breaches? But that alone doesn't illustrate the exact scenario. Really what's more relevant is what kind of controls are in place to even detect that a breach has occurred. So there's often cases, and we've seen this in another M&A transaction a few years back. It was a hotel chain acquired another hotel chain, and 3 or 4 years after the acquisition, it was revealed and discovered that an ongoing data breach had occurred kind of pre-deal. And so it wasn't uncovered by either the target or the acquirer till late. And at that point, it's too late to go back and sort of correct. So there's certainly some cost potential that could occur even if there's no breach known at the time of the deal. And then, so I just note some other ways to vet targets. You could have, say, a dark web search to see if some of their data has been put up for sale in the dark web. There's certain vendors that can do that kind of thing. And then take a multidisciplinary approach. There's lots of different elements to a good cybersecurity program, and having the right experts look at that and evaluate it is key. All right, we can go ahead and jump to the next slide. So kind of takeaways here. I know we're about at time. So just think about this in terms of both data protection and product safety risk. Both of those are important. I think a lot of times those on the target side tend to think about the product and the product alone and forget that there is another element of data that's very critical. And sometimes I think vice versa, the acquirer might be more focused on the data and not necessarily think about the product just because of who is involved in some of these transactions. And then also look at vulnerabilities and process gaps, kind of anticipate what those would lead to, rather than simply looking at some sort of record of what's actually occurred in terms of negative impact. And then, of course, take a risk-based approach and understand you can't cover every single detail and turn over every rock, but look at what's really critical. And then finally, be aware that you might have increased threat based on the announcement of a deal. And so if there is some gap that might occur in that stretch, be extra vigilant, have the awareness of that going forward. So we'll stop there and pause for questions.
Great, thank you, Paul. If anybody has questions, please enter them into the questions tab. I don't see any right now, but we'll give it just a minute or two here.
Yeah, Amanda, and I'd also say if anybody wants to reach out post a session to either the BMO team or obviously Gardner, please feel free to do that as well.
Absolutely. Yeah, we have a question about the slides. They're actually under the handouts tab as a PDF. Should be able to download them there. If you have issues, let us know. But yeah, ditto. If anyone has questions or follow up, feel free to reach out to anybody either on the BMO team or Gardner. All right. Well, with that, oh, looks like, hold on, one question about this. Okay. Megan, I see your question. I will email them to you. I have the PDF, the full version. All right. Well, with that, thank you so much to the BMO team and the Gardner team for setting this up, and hopefully everyone that attended found it beneficial.
Great.
All right. Thank
Thanks,
you.
Amanda.
Take care.
Thanks, everybody. Bye-bye.
Bye.